And when the nation is young, that means rising consumption, rising demand, and rising aspirations, which means to harness this, we need access to capital, we need market confidence, and we need institutional partnerships. And that brings us to our next session. Public markets and institutional capital are increasingly reshaping the growth narrative of India's hospitality sector. Listed, liquid, and restless, the race for growth. The session brings together leaders from listed hotel companies and institutional platforms to discuss how access to capital, scale ambitions, and market ambitions are influencing expansion strategies and long-term value creation. Ladies and gentlemen, with a round of applause, it's time to welcome our very formidable lineup of speakers.
No, I'm standing. You might want to turn that this way.
Over to Mr. Sethi.
Thank you. Good evening, everyone. Is there any way we can encourage more people to come in? Not happening. Well, you know, we are competing with beaches, sunsets, and cocktails. And now we have another tough act, which is Mr. Kapil Dev himself. So we want to keep our session sharp, honest, and try to make it more stimulating than Sundowners. And hopefully we'll hold you in by then. Just quickly in context, I think we're in a very strong cycle. It's been a longish cycle. We hope it'll go on much longer. Current views that probably next 3 or 4 years look good. Balance sheets are strong and clean. The capital is flowing, so that's available. But the cycles also look the strongest when they're about to be tested. So we're going to talk about that a little bit today. And my first question is to everyone, maybe we start with you, Raghu, and then just go sequentially after that. In your view, how durable is this current growth, if you were to look at it from a 3 to 5 year cycle? And importantly, how are you positioning for the upside and protecting the potential or maybe a downside at some time?
Good evening, everyone. So I think there were 3 presentations since yesterday which stood out. First was Anuja's presentation, which said commercial office space still remains strong. Warehousing remains strong as well. And while residential, we still had a debate on it. So that was one bit. The other one was from Bain, I think. So just the demographics of the country and what is expected in the next 5, 10, 15 years. I think we are in a good place from a hospitality perspective because we've never seen such a strong cycle, which is demand-led and not just inflated. So I think this cycle is here to stay for a while. As I'm saying, whether it is high single digit or whether it is double digit, that only time will tell. But for the industry, the cycle is here to stay. From our perspective, we will continue to look at mixed-use hotels as part of our office parks. And we still believe, and there was one more presentation which I would kind of refer back to, is the Gleeds presentation. If you look at the cost of construction and the way that is going up, if rates don't continue to grow, we would have issues. So I think keep an eye on cost of construction, but this cycle is here to stay.
All right. Fair amount of clarity, Raghu, for that one. Rahul, do you want to take the next part? You're going to throw some data at us, I'm assuming.
So since you asked about India, so what's very interesting is in 90s and 2000, in my earlier role, when we would look at data, India didn't have too much data. So for demand proxy, airlines still had decent data. So I would say, that's a good indicator. So I still remember like 280 aircraft and forward movement 20% plus, and these were the sectors. So you had a sense to say this is what was happening. Now today when I see, India has 771 commercial aircraft in the skies operating. Another 1,800 have been firm ordered, of which 200 are replacement for an aging fleet. So net, 1,600 aircraft on a base of 771, I have never seen this. And I'm more sanguine about airlines because most of their thing is, wet lease with a 30% commitment. So their, forecast and projections better be right. And separately, if I see on the demand side, and because all of us in this room actually represent only the tip of the iceberg, which is the more branded formal sector. We have under 200,000 keys. And somebody was asking me, do we even have sufficient demand capacity? Look at airlines. We have 500,000 people traveling by air today. If we say half the guys are doing a return journey back home, so 250,000 people need a bed to sleep. Intercity train, there are 4 million people traveling. We bisect and apply the same logic. So 2 million train guys need a place to stay. Surface transport, 7 million people. Bisect, 3.5 million. So this means our total lodging demand is 5 million beds. Now, obviously, people are not on the street. So where are they staying? The informal economy, the mom and pop guest houses. And I have this theory to say the reason all of us Indians love our relatives so much, because, hey, if you don't find a good room, I could tell Shwetank, I'm coming to your place, buddy, can I stay with you? That keeps our bonds very strong. But jokes aside, the potential is huge. One is, while India and China are different stories, and today we typically lag China on a decadal basis about 15%. So whatever China does in 10 years, if we maintain our growth projections, we'll reach there but 15% less. So 1990, India and China GDPs were quite similar. In fact, we were ahead. India was 368 per capita and China was 319. Today, India is 2,800 and China is 13,000. In the last 3 decades, that's where China has gone. China today, their branded lodging stock is 7 million rooms. A great but small country like Japan is 2 million rooms. Thailand is 900,000 rooms. UAE is 200,000 rooms. And India is 190, which is up in there. So I think great potential for India. And what's now changed is, as we've heard during the day also today, that for the next 10 years, I think we are on the runway to an upwards trajectory. Because our supply growth over the last 2 years compounded is sub 5%. And our demand growth today, which is essentially only the domestic market, is at 7.5%. And room nights consumption in our top 12 cities is effectively 11% year on year. And this is when international MICE hasn't come in. This is when full corporate travel hasn't resumed. And earlier in our demand stack, international MICE was 4% and corporate travel was another 2%. So imagine when 5% more demand growth comes in. So unless there is a black swan tomorrow, because we don't know, there is trouble somewhere, somebody decides to push the wrong button somewhere. If that doesn't happen, my view in India is that, we are all lucky to be here. And quickly, all of us represent listed capital. What's also happened now that earlier hospitality was cyclic. In India, I saw 3 decades where we had, if I mapped it over 9 years, we had 3 years of high, 3 years of shoulder, 3 years of low. And we would tell each other to say 3 years ka hamara 5 years ho jayega. Nobody would say full 9 years I will be like this. But now we are set in place where actually, because this structural shift has happened, the cyclicity is absent. It's actually linear. And what is very good is that today our RevPAR growth is beating inflation. This means this asset class from being an ancillary is pivoting to being a core asset class. And my view is, great data, and I saw Anuj's data, office consumption 83 million, that even office was an annuity class. To me, if we are beating inflation, we are actually producing an annuity plus hotel asset class in the country.
That's great, Rahul, and thank you. And I did share earlier on that we'll get some data our way. Thank you so much for that, Rahul. Shwetank, you want to come and add your view to this?
Yeah, to be fair, Sanjay, I warned you. Don't ask that question to Rahul. But, but what it does is that makes my job very easy. So
True.
Let's just say the macros are good. The macros are looking good. I think the only thing that can trip us up on this journey and this cycle is a VUCA world, which none of us can control. So let's set that aside. And it's supply. And unfortunately, while we keep talking about the industry being a, sort of a long hold, long journey for everyone, for the owners. But what happens is that supply tends to come in cycles, and they unfortunately come in micro markets. So if you happen to be in one of those micro markets where the supply suddenly hits you, then you will have some trouble coming your way. That's all I can say. I think overall the health of the industry stays strong. All the numbers Rahul said, absolutely agree with that. And the fact that there is demand-supply arbitrage, that's also an interesting fact that stays with the industry. Supply can't sneak up on you. So that's the beauty of having a long gestation build out. And that's how we look at the industry. Overall, in a long bullish run, but some micro markets can have softer periods.
Thanks, Shwetank. Neel, you're on the spotlight.
Yeah.
Go ahead.
When you were asking the question, I was thinking this better hold true because I've bet my next phase of my career on this industry. So I just hope the demand is long-standing and strong. But purely from my perspective, and Sanjay, I've only have limited, let's say, vantage of lemon tree in the last 5 months. I guess the best way we can protect the downside and maximize the upside is first, I guess, stay true to who we are, and therefore stay in the lane of being the mid-scale operator, and not get dragged into fancy adjacencies, let's say, as we execute the strategy. Capital discipline, of course, where do we invest, how do we invest, and therefore understanding the right trade-offs, even when the cycle is up. I think that is where things starts looking lucrative, everything starts looking lucrative, therefore discipline is critical. And eventually, I would say, protecting our cost structure. Vinay Dubey was here yesterday, and he talked about having a very competitive cost moat, and which we believe we have, and Patu's done exceptionally well over the last 20 years to keep that. So, in summary, staying the course, cost discipline, and capital discipline over the years will potentially help us, have a fundamentally enjoyable ride in ups and downs.
Thanks, Neel. And Rahul and Shwetank have already actually shared answers from their side on my next question, so I'll limit this question to Neel and Raghu. Are we an undersupplied country, or is overbuilding wrong in these smaller micro markets? 20-second answers, please.
So, of course, we are undersupplied, right? 1.4 billion, there is just no question. I think so. Rahul said that as well. And what was the second part, Sanjay?
Second question was, or are we overbuilding in some of the micro markets?
No, not at this point, I think so. No. Probably a couple of years down the line, you will see. Classic example is the city we are in, right? We said, listen, there was oversupply in Goa, but again, fine. We've not dropped from the top, right? There have been minor corrections in RevPAR in Goa. It will come back at some point, so I don't think so there is
Sure. Neel, I know you've spent very little time in the industry, but given that, what's your, off-the-cuff reply?
No, I have a similar answer as Raghu. Clearly undersupplied, and I don't think we're overbuilding yet. I can draw parallels, Sanjay, from the last industry where there's fair amount of, penetration of stores, malls. I don't think that we can overbuild in this phase of India. So if you all believe in India, I guess we're building it right. There might be small mistakes here and there, which do happen, but clearly, fundamentally, we're not overbuilding yet.
Sure.
Also, Sanjay, the big boxes are not being built right now, right? So we just have to be aware of that.
Not true. We just announced one.
We're opening one.
All right. Raghu, the next question is specifically to you now. In your company, hotels sit inside a REIT with the other asset classes. how do you see the risk and return of hotel assets in your REIT portfolio?
So of course, we're a commercial REIT. The hotels are only 6% of GDV, right? So that's fairly small. We saw the risk during COVID, I think, so that was pretty evident. But we've seen the reward after COVID as well. There's certain locations where we evaluate, and we were speaking backstage as well, where hotel kind of outpaces office as well. And I think so that will continue to happen from certain location to the other. But overall, of course, commercial still rules this country. That would not change.
So will you guys, are we likely to see you getting a hospitality REIT in place in some point of time?
Great question. Someone asked me this question 5 years ago. And so see, Sanjay, REITs traditionally like annuity, and you need to be 80% income generating and 20% under construction. And you need to distribute your cash flows. If there is ever a hotel REIT in India, you would need to have really stable assets. The larger question is, what value will you get for it? If the value is right, we might get it, but that stable assets are only in 2-3 cities. So it's about valuation and scale. I think so we are some time away for it, probably 4, 5, 6 years down the line, maybe yes.
So you feel that whatever hospitality assets you have in a portfolio are actually either performing as well as the office assets or overperforming in some cases? Or do you think they're a drag at some time?
So Sanjay, the difference eventually is the stabilized gestation period, right? That's how the asset class is. But in certain locations, once you stabilize, your EBITDA per square foot is at par with the office rental per square foot.
Okay, Rahul, can we come to you now? You guys are doing big box hotels, quite a lot actually. Where do projects of this scale tend to throw up headaches, or where do they stall? What has been your experience with big box or mixed use developments like some of your projects?
See, big box, mixed use, especially in partnerships. I think there are 3 layers. Broadly, first is the entire regulatory layer. Then the second is the capex layer. And third is really the partnership alignment layer. Now at the regulatory level, for example, just getting land clear, whether it is meeting SRA obligations, legacy encumbrances, getting clear titles. Once you sort that out, then the next level actually becomes, environment, aviation, fire, traffic, municipality. And even there, once you aggregate, what happens is that across different asset classes, the regulators may also be different.
But Rahul, if I ask you a question, name one issue with developing hotel assets, especially large boxes, that'll keep you awake at night. What would that be?
I think one issue where if we do a good job in the beginning, which is to get the entire governance framework around the partnership right, will cause any developer to sleep more comfortably. See, the key issue is when you are doing multi-format development and big boxes, first is how are you, the project is not so much about cost control. It then becomes cost attribution. So, as a very simple example, let's say you're doing a multi-asset development, then there are shared areas, there is, there is basement, there is podium, we have cooling towers, you have vertical elevation, there is STP and water. You can't just say I'm allocating per square foot because different asset classes have different intensity. So hotels, for example, will have greater intensity on MEP and back of the house. Retail may have greater intensity or on, let's say, parking. One is getting that clear upfront. And the second is in partnerships. See, the issue is...
Rahul, I'm afraid we'll have to cut this short.
Okay.
What one item keeps you awake at night as far as hotel development is concerned?
What one item would be to say, are we, if I was to oversimplify it, are we going to be finishing in time?
So you think time is the biggest risk?
Time is the big risk.
Great, thanks. Shwetank, we'll move to you now. Chalet has been listed now for 7 odd years now. Do you feel that public markets tend to shape the balance between growth and volatility?
Very scary question. Actually, I don't like this quarter-on-quarter living that we do, but that's the law of the land, so we can't help it very much. But you're right. I mean, the requirements of compliance, the fact that we are publicly listed, does have a bearing on how we look at our business, and we can't wish it away. And very clearly, private companies have much more leverage when they sort of do this on their own. But having said that, it also makes us disciplined in terms of our reporting structures, etc. And with growth, volatility can be expected. It's nothing new. They are two sides of the same coin in my mind. And we have to learn to manage that volatility, whether that's coming through, let's take an example. As a public company, we are expected to grow our margins year on year. But sometimes it's just not possible. It's not possible because either you have maintained a very high standard for years, and now the rates and revenue growths are not keeping line with the cost structures. Or you're adding a leisure portfolio to a leisure hotel to your portfolio, and those come at lower margins. Then you have to sort of the blended margin tends to go down. But it all has to be explained, and it has to be done because the investors have to be educated. So yes, they do have a big bearing on how we run our business.
Okay, then an interesting question for Chalet now, and I suspect I know the answer. But I'm sure the audience will be interested in hearing this about Chalet. The next phase for Chalet, expansion, deepening, or capital recycling?
Yeah, very interesting question. So I think from Chalet's perspective, and I suspect, as you say, you can probably answer this question better than I can. But still, we have our stated strategy on expansion has been very clear. In terms of big boxes, we want to be in big cities ahead of the infrastructure curve. We like concentrated beds. If you see any of our examples, we have always gone for bigger boxes. It gives us better unit economics, helps us with the clustering, etc., etc. So that's something that we'll continue to do. We like greenfields as well. And we know we built efficiently to time, cost, and quality. All the headaches that Rahul is worried about also keeps us awake. But thankfully, we are doing this alone. So the partnership challenge is not with us. But we know that leisure is difficult to build. We have been a Western India-centric company for a very long time. So doing greenfields in what I call far-flung places from Mumbai becomes difficult for us. And therefore, our recent acquisition strategy, you would see we have gone and acquired, built hotels in the Himalayas or in Delhi NCR, etc. So that's a strategy that will continue. So we will continue to deploy capital in value-accretive assets. We definitely are not going to recycle. That's very clear. We are in this for a long term. We are a publicly listed company. We will hold on to all our assets, and thankfully, we don't have any dogs in our portfolio. So we will continue to hold on to all our assets. Of course, the focus will be very deeply on our existing assets. We'll sweat all our assets. We'll continue to drive the margins and make the most of our existing portfolio and grow it. So that's the broad strategy.
Thanks, Shwetank. Shwetank, quickly a question on the new brand launch. I'm sure the people in the audience would like to know what the plans are for that, and how do you see that as a growth tool for the company?
Yeah, this is one of Sanjay's legacy to us. I mean, he's handed over a great brand. We launched our own brand called the Athiva. Right now, we see Athiva as an experiment, and that experiment is in the continuum of being an asset owner, moving to a franchise operator, and we have now become very serious franchise operator with the first Taj opening in Delhi. Coming soon, it'll be our first big box as a franchise owner, and then Hyatt Regency follows closely after, and so that will make it 4 or 5 hotels that we are running. In that continuum, the next journey is the brand, and that brand has been launched on some very strong fundamentals. And the way we are looking at this brand is we will first prove to ourselves we can do it. We want to prove it to the guests that we can deliver on this promise again and again and again. We can make all the strategies, which was what we were doing 6 hours with Sanjay and the board this Monday. But if the person on the ground is not delivering the basic last mile service, all our strategies can go into the dustbin. So we have to make sure that the strategy is well formed and well communicated down the line, and we can deliver that promise to the guest again and again and again on our own properties. It's when we are fully confident that we can do this and do this consistently and at scale, it's only then we will consider, and I just reiterate that word, we'll consider going third party only at that stage. So nowhere close on the horizon.
So that I saw Neil's attention suddenly getting caught over there when you said that you might go asset light at some point of time. So Neil, coming to you, you've got again owned assets and asset light hotels that you run for others.
Yep.
How do you decide between the asset light growth or the ownership-led expansion in the current and the next cycle?
Sure. Pretty much how we've done this so far, Sanjay. If you look at our portfolio, there are about 130 odd operating hotels, 120 in the pipeline, of which 41 are owned. The owned inventory is largely along the big cities and demand-dense areas. So we'll continue with that. We often say in Lemon Tree that we'll compete for demand. So we're happy to go in and compete for demand rather than go to locations where we have to create demand. So think of us as going to areas where demand is predictable, cash flow is there, you can fill the rooms easier, so airports, highways, tech parks, CBDs, and therefore, when the conviction is high, demand is predictable, inventory requirement is large, we'll get there ourselves. The other vector, which is tier 2, 3 cities, tier 2 cities, tier 3 cities, where local conviction is needed in a bigger way, and we might not have that conviction yet, there we'll go third party, and therefore, the hotel in Chitrakoot or Najibabad, etc., they're all managed. And clearly, the strength of the owner there versus our conviction and our conviction for demand-dense areas and the owner's strength in managing that portfolio is very different and complementary in many ways, and therefore that will continue.
And if I was to ask you to hazard a guess, what percentage of the portfolio in future is going to come out of owned asset and what through asset light? Just throw a number. You think is probably the right sort of number.
Yeah. So in terms of rooms, I think it predominantly will be managed. Yeah.
So asset light is going to be
asset light. Yeah, clearly, I think let's say 25, 75 over a period of time.
Sure.
Yeah.
Great. And in the mid-market, where you're structurally primarily positioned, do you see that segment as an advantage over luxury or upper scale hotels in this cycle?
Wow. Predictable for sure. Like you said, I mean, we'd have lesser leisure properties, and therefore that helps us, let's say the predictability of cash flows, filling the rooms, driving ARR, let's say over a period of time is far more predictable on the mid-scale side. So I'm not so well-versed with the luxury side yet, but mid-scale seems to have a larger runway in this upcycle. And given that it's a scalable product that we've built over the years, I believe we are ready to scale faster than a classic luxury or a leisure bet.
Sure. Thanks, Neil. So this next question is, short answers to two questions, and we'll have start with Raghu and then go down. Raghu, as per you, one structural risk that you think we haven't thought about or are underestimating at this point of time? For our industry, of course.
I'll go back to cost of construction.
Cost of construction.
Absolutely, I think so. We need to keep an eye on cost of construction because in our case, cost of capital, we know what a cost of capital is going to be. But the cost of construction and the time period for construction, as you said, because there are labor issues, there is skilled labor issue, and whatever said and done, it is still taking minimum 4 years to, do hotels. So these are two things I think so we need to watch out for.
Sure. And Rahul, one risk that you think we're underestimating at this point in time?
I think the talent risk. Yesterday, I was reading a draft paper. I think Israel is saying 50,000 people to come into manufacturing and services. The government's doing an agreement with Russia, 200,000 there, and slowly Europe will wake up. So currently, our hotels, depending on cities, maybe 40-50% attrition. When effectively we are attriting internally. Now imagine when a big swath of a blue collar and white collar, and this is B2B, government opening doors and inviting. I think, and this will happen, because Israel will be a great experiment for countries to model on and see. I think in the next, and it'll probably come to us faster in my mind than we think, in the next 2 to 3, 4 years. As the world ages, the good thing is India will become the workforce powerhouse to the world, but what will it mean for our industry? I think we have to be very, very cognizant of that. That's a big albatross.
So Rahul, you said talent flight is your biggest risk that we're underestimating. Shwetank, thoughts?
I actually echo Rahul. The only thing I would add to that is that, today you have to see talent risk not just at the hotels. Look at our case, for example. We are building, we are running hotels. Now, running hotels, attrition is well established. All of us are aware. But what's happening in the ecosystem of our development is that there are contractors, there are consultants. I bet you the quality of work that is coming back today from consultants and contractors are far, far worse than what it used to be. And it's because they are having a talent crunch themselves. And the way to manage that is to go and find your own niche with them, partner with them, work with them, so that at least their best work that they are producing comes to you. And that challenge is, totally exploding as we speak. And the third biggest issue that Rahul referred to is if you look at your talent in the corporate office, today hospitality-trained talent, everybody wants it. And no matter what asset class you are in, especially in real estate, you want your commercial to be hotelized, you want your residential to be hotelized, you want everything to do with commercial real estate to have a hotel talent behind it. That means everybody you have is at risk today.
Neel, thoughts?
Yeah, kind of agree, but I'll just go a little higher. I guess the biggest risk over a period of time would be to manage costs and do the right trade-offs. Because I guess supply side, demand side is kind of taken care of in this cycle. The operating leverage will come from taking the right trade-offs and managing costs, because there will be inflationary effects on almost all kind of costs, construction, labor, etc. And therefore, what trade-offs and how do we manage so that the cost model is intact and therefore operating leverage shows through in good times or bad? That's the bigger risk as well.
Thank you. One final question, then we'll come to the closing again for everyone here. And let's make it really quick. One bold move Indian hospitality capital markets will see in the next 2-3 years. Raghu, thoughts? You can't think of anything that you see coming up. Rahul?
See, I think probably two things from, let's say, an external FDI or a PE perspective. Whenever you're looking at any country returns, India for a geography returns, let's say in that basket, had, let's say, 2.5%, greater IRR attached. I think while that's going to go away, the fact that on a secular basis, rupee is depreciating 2.5-3%, I think that will stick out. But having said that, I think hospitality is going to move into the center as a core asset class. So instead of being an alternate strategy, I think it's going to become a core strategy.
That's pretty evident, right? I mean, look at the number of organized listed players in the space of hospitality that have come in the last 7 years.
Yes.
We've doubled the number of companies, listed companies that are there. Thanks, Rahul. Shwetank, anything that you see on Indian hospitality capital markets that's likely to change?
Yeah, I think somebody will buy or merge with Leela.
Okay.
So that's
Neel?
Out of syllabus for me.
Out of syllabus. All right. On that note, we're going to come to the closing now. Ladies and gentlemen, we may debate models, but Indian hospitality has entered a structurally more confident era. we believe growth will come. All of us on the panel believes that. I too. The question is, will we deploy the capital wisely enough to deserve it? Thank you so much for your attention and all the best.